embedded in having a fund on the market.
It's because it's coming from an investment company, too.
Yeah.
Like Vanguard put this thing together. Vanguard's not operating out of charity.
Right.
They're operating at a very low cost, and they're doing so and saying, listen, we're not marking this up much.
No,
you should buy it from us because it's cheap.
I mean, let's be realistic. The Vanguards and the Fidelities, they're really going for volume, right?
Yeah.
And so if you're doing a ton of volume, you've got to have a lot of people. And what's an easy way to get a lot of people? Don't charge very much. Right? Like, how do you think In-N-Out makes a profit on their $5 or $3 cheeseburgers?
Volume.
They have a ton of people in line, and they're just lined up and ready to pay.
Right.
Same thing with your Vanguards and Fidelities. It's the In-N-Out experience.
Mm-hmm.
But guess what? When you go to In-N-Out, there's like 4 things on the menu.
It's true. It's a pretty limited menu. So let's back to our concept here. For all of you guys wondering, like, where am I leading you on this? So Vanguard is the discount offer of, I can buy a really cheap tracking mechanism to buy the S&P 500, right? But there are other versions of mutual funds, and we start adding more fees to them, right? So, for example, do we have fees that are, well, you know, gosh, there are more fees than that. I'm looking at the clock, and I just realized we're already running long.
No, we're not.
Oh, we're totally running long. All right, yeah. We're going to tell you more about the mutual fund fees, but we're also going to grab a break first. So let's do that. When we come back, we will, dig deeper into the fees, and we're going to help you understand. By the end of the show, the goal is for you to understand enough to go out there and be pretty dangerous with it. Stick around. We'll be right back. I'm Dave Littlejohn.
And Matt Dixon.
And you got True Wealth on News Radio 99 FM and 1240 KQEN. God bless. Can you turn the volume on that, like, off?
Yes.
What is happening over there?
Because it was scheduled, it wasn't working. There was another step that I needed to do, and so but now it's live streaming.
Okay. Well, you know what? That's why we put memory cards and cameras, so that we will have backups.
And now I know for next time that you have to click live after it's already looking like it was on here on the screen.
Yeah, it's going, but you have to tell it to stream.
But then, okay, so let me figure out how to turn my notifications.
Well, nothing gets you, like, nothing teaches you faster than terror.
Yeah, that's true. Like, you'll always know where that button is.
Like, that doesn't happen twice. All right.
Now I know all the steps, hopefully.
That's funny.
Yeah.
Okay, do you know how to turn your notifications?
Notifications.
Or like the sound for the notifications?
Yeah, in the lower right-hand corner, there's a little icon for the microphone. Click it, and it'll go to mute. Okay. Now's my chance to prep you for this. I don't want to get too deep in the weeds on each level of fee, or we'll never get through this, right?
Right.
We got to cover. There's the standard costs, so right, upfront loads, back-end loads, 12B1 fees.
Do we even need to get into that?
Well, we need to get into it fast, because I think what happens is you start to, if you talk about a mutual fund and you don't cover those, then people are going to wonder, like, what are you hiding?
So just maybe, do you want to talk about, I'm not going to be good enough on those, to be honest.
Let me jam through
I
these
know
fast.
what they are, but I'm on live air, I'm going to bumble that. So.
Well, let me jam through those so that we can get back to it, and then what was supposed to be segment 2, getting into the advice side of things. I want to talk about all the different fees that people don't see in these, but fast.
Yeah, because that could make for some good, clips that turn into a short. Especially if you frame it up like, did you know that you're paying for this?
All right, again, welcome back to the True Wealth Radio Show, where my main man,
Matt Dixon.
Yeah, it's exactly what I'm talking about. Today we're talking about fees. If you want to get caught up, grab our podcast and you get hooked back up. It's also be posted on YouTube shortly, so you can check back there. But and we're live streaming right now if you want to look in on the studio. Like we talked about this before, Matt's the good-looking one. Matt's the loud one.
Some days. David, what are people paying for? They don't really know that they're paying for it, or they don't understand how the payments really work. Because nothing's free, right? We all know that. There's no free lunch. So where are we spending the money?
I'm going to go through a a laundry list of fees that people need to be aware of, and we're going to go through this fast because I want to get into the things that you're going to care about, and how it applies.
Okay.
We started to talk about mutual funds, and there's a few flavors of them, right? You have no-load mutual funds that are oftentimes things like indexes, right? Remember, indexes just means that there's nobody making a decision around it. They're following kind of a recipe or a formula. Okay, so mimicking another index out there. Oh, the S&P 500, fine. We'll do what the S&P 500 does. Okay, then you don't need a manager for that. You just need a babysitter. Right? So the computer can do that job. So you can reproduce something like that pretty inexpensive because you don't need a whole lot of personnel, right? But you still need the technology and the other stuff. So it's offered through a company. Mutual funds are investment companies, right? So they're going to charge something for it, and that's what the base operating costs are. So if you've heard of an expense ratio, that's usually what's included in there, is the operating costs. There are a couple other things to know about. You have loaded funds. Why do they call them loaded? Because they have commissions built into them. So they're either on the front side, like when I buy it, I pay a commission, or a more sneaky way to do this is you don't pay a commission up front, but if you sell it early, you have to own it for a certain amount of time, but if you sell it in less time than you're supposed to, they charge you on the way out. Right? So there's back-end fees. They get you on the way in or they get you on the way out. If you do that, oftentimes the expense ratio is higher. So they're saying, you can buy this thing.
Right, because you're basically delaying the payment, and so they want a little interest
Think
on
about
it.
it this way. I can pay less for the car, but it gets worse mileage. Right? So that's the different trade-off, the way that kind of works. And that's mutual funds. There's some fees in mutual funds that they cannot report. Like there's not a way. Actively managed funds, as an example, they can tell you turnover ratios, but they can't really tell you what their trading costs are. Why? Because they don't know what they are in advance. Right? There's no way to say what it's going to be.
Right,
So
you don't know if you're going to place 100,000 trades for that mutual fund or if you're going to place 20,000.
Right.
And so the fees can kind of float.
Yeah, plus institutional trading often works differently than retail trading.
Right.
So you and I go and buy a stock in Robinhood or wherever else, and you may pay a transaction fee to make that happen. It's not a commission, by the way, not in the traditional sense, because I may pay $3 for a transaction, and it's whether I buy 1,000 shares or 2 shares. It's the same transaction.
Okay.
It's more like postage, right? I have to just pay a standard amount for whatever this is. But those are relevant fees, but you can't. The institutional markets, sometimes they trade directly with each other, so there's not a commission associated with that trade. They're just saying, hey, Vanguard's trading with Fidelity. You guys want to block a Microsoft and we want to block a Google, and if we each have it, we'll just swap them. Right? So that stuff can happen in institutional markets, and it looks different. But that's the way those instruments work, is they have built-in fees, some that you can see, some you can't, and you have to kind of be discerning about how you look at it. Now, I told you on this show, one of the things I wanted to do is help keep you from getting ripped off. This is one of those things with mutual funds that I want to encourage everybody to do a little homework on. Maybe grab Google or ChatGPT and you can look this up after class, okay? The concept is something called R squared. Now, you don't need to know how to calculate this. Lots of places will do it for you. But this is a statistical measurement. Matt, we've talked about this before. Do you remember R squared?
Yeah.
You know why it matters?
Yeah, I mean, it's because that number is going to tell you how much of the movement or the performance of your holding is going to be attributed to what we mentioned earlier, which is the index, right? And so if it has like an R squared of like what, 1, it's
that is the index.
That is the index, right? And if you were to have like a 0.75 R squared number, that means 3/4 of your performance is coming.
And that's pretty good, by the way. If you had 0.75, no red flags. If you had 0.97, what I would tell you is, wait a second, 97% of your return is the same as the index.
You are the index.
Yeah, I mean, like that 3% difference is statistically insignificant.
Well,
but if you're paying a lot more in expenses, why wouldn't you just get the index?
I'll tell you this. When I do proposals, I'll tell you that most, I'll just use a broad term, most of the funds that I look at that people are holding are over 0.9, right?
Yes.
Like,
yes. The bigger the fund, the harder it is to have discernible difference in R squared.
Most people just own the index and they think they're diversified.
Yeah. Well,
and then when you have to break the news to them, they're like, wait, what?
Right.
Wait, so you're saying I basically just have the S&P 500 and I'm 2 years away from retirement, and I thought I had, maybe a bunch. No, you didn't have a bunch of bonds.
That's kind of different in my mind, right? I'm thinking about a large cap mutual fund that has a R squared of 0.92, and you go, I thought that I was paying for this great manager, right?
Oh,
and it turns out the great manager is 92% the same as an index fund. But instead of paying 0.05% or 5 basis points, I'm paying 125 basis points to my manager. You go, why am I paying so much? And the performance is so similar, right?
Let's give listeners a really easy example. What if you just took half of your portfolio and owned the S&P 500, and then you took the other half and you bought the NASDAQ? Most people would probably think that you're really super diversified.
Yeah, and you're not necessarily that diversified. It's all stock. You're pretty tech heavy because of the way they're built these days. I mean, you do own more stocks. Your R squared would likely change.
But there's a lot of overlap.
There is a lot of overlap in those indexes.
Right, because some of the positions in the NASDAQ are in the S&P 500.
Well, and here's the clever thing about R squared. So overlap can be misleading, right? You can actually be diversified and it doesn't help you very much. Let me give you a real life example.
Okay.
Go look at Home Depot and Lowe's. Okay?
Yeah.
They're different businesses, but they're doing such a similar thing. Right? They're competing with each other directly. And so what you would have as an investor is diversification, but really high correlation. Mm-hmm. Which means when assets are highly correlated, your diversification doesn't work very well. Okay?
Correct.
That's it. Let me say that again. When asset correlation is really high, diversification doesn't work as well. Right? It's less effective.
Yeah.
So for diversification to be more effective, you need the correlation across the different investments to be lower. Right?
Right.
So that's the idea here. I often use a sports example, right? If snow skis and snowboards are highly correlated. Snow skis and baseballs are not. Right? They're both sporting equipment, but totally different seasons and totally different use cases. They're both sporting equipment. They're in the same marketplace, but they're really pretty different. Okay?
Yeah.
That's the difference between something highly correlated and something that is, low correlation. And so that's how you improve diversification. These statistical numbers are how professionals can sniff that out. Because you could have a mutual fund that owns stuff that's different than the S&P 500, but if it still walks and talks like the same duck, is it really any different?
Right.
And that's the issue here. Sometimes what you're doing is you're paying for marketing rather than efficacy.
That's a good point.
Yeah, and that's what we're looking for is what are you getting what you're paying for? That's the difference between am I getting something for cheap? Am I getting something affordable? Or am I just getting ripped off?
Right. And if you're paying a lot in fees and you're not getting any diversification or you're not getting anything customized for you and you're just getting the index, what are you really getting?
Yeah, I mean, what happens if you have a phantom index? That's something that bothers me. Is somebody thinks that they have purchased something from a manager, they think they're getting some kind of enhanced return. Maybe they even used to be. That's the other issue, is mutual funds that are really successful have a struggle bus ahead for them. Because a really successful fund attracts more investors. More investors means more dollars. More dollars means you have to put those dollars to work in the market somewhere. And as your investment opportunities dry up, you have to start buying more and more stuff just to keep the money working because you have a prospectus that says you have to do it. Now, what does that mean? It means, great, I've run out of the investments that really made me a great performer. Now I have to kind of buy the second tier stuff that is less attractive, but I got to put the money somewhere. And I start to look more and more like an index as my fund gets bigger and bigger and bigger.
Yeah.
And these are just mechanical constraints. Mutual funds can't have controlling ownership stakes. There's a lot of other issues at play there. So they can run into the penalty of great performance. This is also, by the way, why it's really hard to find small cap mutual funds that are still open. The great funds close and they said, all right, everybody that's new investors, you're out. Only the existing investors get to own this. We're closing it to new money because we can't have the inflows.
Yeah, I mean, if it's a small company, you can only buy so many shares.
Yeah. Well, I've talked about the markets. You can be so. This is a fun one. I'm going to drop this point and then we can take the next break. The point is, institutions, it's hard, right? If you have several $billion, You're not going to tiptoe around and nobody's going to notice when you're throwing billions around. Okay?
true.
You have a few million, you can be a rounding error in the trading volume of a single stock in a day.
Yeah.
Right? Go look at how much Microsoft trades in a day. It's millions and millions and millions and millions. It's probably billions per day. You drop $1 million on Microsoft and nobody notices. Right?
Correct.
But you drop 10 billion in Microsoft, somebody cares.
Right.
Right? The market
You
will
just
notice.
moved the price. You moved the value.
Yes. And so as funds get larger and larger, there's the penalty of that institutional transparency. It's harder and harder to tiptoe
Well,
around.
a lot of people don't realize there's some really, really small companies on the stock market, right? That are trading, a couple $1 million a day around. And if you came in with a couple $1 million, you could buy up all the shares that are available that day for purchase.
Well, think about Warren Buffett. How hard would it be to be Warren Buffett now when you're sitting on hundreds of billions of dollars and you could buy entire companies, but you're not
easily.
allowed to.
Yeah.
Right? You're not allowed to in some cases. And so people say, well, Warren Buffett's got these huge cash positions. What does that mean? And I go, yeah, but how does Warren Buffett now identify another fantastic underpriced opportunity that's going to deliver excess value to his Berkshire Hathaway shareholders at that scale? At institutional scale, really? The whole world's looking for these bargains. It gets harder and harder the bigger he grows. Mm-hmm. So pretty remote, which means, hey, you probably should be really patient until the market pulls back a whole bunch and then go buy stuff. Everybody wonders, is Warren Buffett a genius? Or is he just really patient waiting for his opportunities?
I think
Maybe
patience-
both, right?
Yeah.
Probably both.
Yeah.
So-
That's a whole radio show in and of itself.
But it is
Understanding the
totally
mindset of
relevant
Buffett.
to understand that the difference between institutional and retail and what our opportunity set is, but also why when you're buying mutual funds, you think, got this huge mutual fund that's got billions of dollars in it, and the manager's been there forever, and go, it's getting harder.
So let me ask you this. We've talked about the cost of the mutual funds. Are we going to start talking about ETFs at all, or are we going to start pivoting over into the cost of advice?
Okay, so we don't have to talk about ETFs very much. You know why?
Why is that?
Because ETFs walk and talk like stocks.
But they trade on the exchange.
Well, they act, they're mutual
Unlike a
fund-esque,
mutual fund.
but they trade like stocks.
Yeah.
And so while there is a cost to an ETF being created and placed on the marketplace, if you're trading those units between other investors, you're really just bearing the transaction cost in that moment. It's when you're redeeming or creating from the institution that the expense ratio is born in those. So they're kind of an interesting animal. They're a little bit of a hybrid. And honestly, that's not where I would be super worried as an investor. It's not that it's irrelevant, but I think the cost, and given the time we have today, I want to make sure our investors get to hear about it. Our listeners get to hear about that.
Well, yeah, let's talk about that.
Okay, well, we will, but I'm looking at the clock. Let's grab this break. When we come back, guys, we're going to talk about, okay, we know how to start analyzing the expenses embedded in some of these things. Now, what's the cost of doing it myself versus getting help?
Okay.
Stick around. We'll be right back. I'm Dave Littlejohn.
And Matt Dixon.
You got True Wealth on News Radio 93.9 FM and 1240 KQEN. All right, I feel like we settled in that round.
Yep.
Did we settle in that? I feel like we kind of got settled in.
Yeah.
I don't know if anybody's watching, right? Sometimes you
We
wonder.
did have 6 viewers.
6 whole viewers at one point. All right, so we were going for it.
Times more than last week.
That's true. That's more than normal.
5 watching right now.
Cool. So, hey, if you're watching, I would say throw a message in the chat and just say, hey. And also, I would tell you to drop questions in there. I don't know that we'll get to them because we kind of have a flow to the show. But if we can work them in, we will if they're appropriate. And, yeah, or we can work them into future shows too. So we like that.
There we go.
Yep.
It'd be kind of cool to see what people think.
It would.
Well, it's this whole live thing. I guess you've done a couple of them, but it's kind of a new experiment. You know what I mean? We're trying to figure out if this is what people want to see, and you're really seeing behind the scenes, like this, the break time between. We talk to each other. We figure it out. Then I point out to Matt, like, we got to see our listeners next. And then you say things like, "Don't make me say that."
Yes.
All right.
Exactly.
You're going to get queued up way more though for the cost of advice.
Can you drop in there?
Kevin McFarland. Hey girl, hey.
Nice.
Thank you for that.
Nice.
I love it.
Yeah. Well, just got your name dropped on
Oh,
real
he said
time
that with
too.
Natalie. LOL.
Word.
That's funny.
All right. So cost of advice Are we into segment 2 finally?
Yes, which
How are we gonna jam this out?
should try and tackle that one quickly and work our way into segment 3 with a cliffhanger because
So we only have one break after this.
yeah,
So we have 2 segments left, so we
we're
need to
gonna
just...
merge 2 and 3, and we're gonna merge 3 and 4.
Okay, I'm gonna lean on you a lot for this.
And boy,
Yeah, well, I mean, you fake created this, and now we gotta fake
true.
finish it.
target date funds, annuities. We already talked about mutual funds. I need a pen.
Yeah.
Is there a pen over there, David?
Yes. Ready? Good throw.
Yeah.
Okay. We could, honestly, we could do an entire show on annuities. The problem is, like we were teasing earlier today, this is gonna be out of context and so it's gonna be less funny, but I was joking about kicking puppies. Like annuities would be a little bit like kicking puppies.
He kept that one in his back pocket.
So, what, you wondered how I was gonna work that in?
Yeah, I
It's
did.
not even hard. Yeah, puppies.
We just lost a viewer right there. I watched it
We actually
happen.
have
real
6
quick.
now.
Oh.
Oh, no, never mind. Now we have 4.
Yeah.
We did just have 6.
Yeah, it
Yeah,
was the puppies
it was
comment.
the puppies comment that did it. Here we go. All right, gang, welcome back to the True Wealth Radio Show. Matt and I are cruising today because we got to get through all this fee stuff in order to get
Yep.
to the goodies. We already covered mutual funds. You grab the podcast to get hooked up on that. A couple more things that are probably hidden costs that
Yeah.
we should talk about real quick.
We were edging into this idea of like, what does that cost come with, like the cheap advice? Like, how does that kind of commingle?
Yeah,
And there are some ways that you can, I think, kind of end up in an area where you might have a low cost, but it doesn't necessarily translate over into you have a low risk profile, right?
yeah, cost and risk are not always correlated, and sometimes, yeah, the cost of something, it's like something is low cost, but it doesn't come with any other guardrails or guidance or even disclosure that is obvious, right? Probably the one that comes out to me, that pops out to me the most is when folks do something like a target date fund.
Yeah.
They just kind of set it and forget it, and then they realize like they creep up on something and then time frame's wrong, and they've de-risked to the point that they actually now have longevity risk instead, and like, oh great, now we're sitting in all these cash instruments because we hit my retirement target, but I have 20, 30 more years to live, and this thing is no longer outperforming.
Yeah, what was maybe 8% returns has dwindled down to 3 or 4%
Right.
for the last 5 years, and so you're missing out on the snowball effect, right?
Yes.
Where it's like, well, I wanted the compound growth, but I accidentally de-risked too early by just being in a target date fund, and the reality is, how many people are in a target date fund because if they didn't go in and actually set the investment inside of their 401k, it auto defaulted to a target date fund for compliance purposes.
Yeah.
And then they wake up at retirement time and they're like, what just happened to the last 5 years of my retirement fund?
Here's
It's like,
another thing that's hard, right? What's hard is that oftentimes people will not engage in the education around their 401k plans.
That's what it comes down to.
They'll set it and forget it, or they'll just kind of throw their hands up and say, it's too hard, I'm not interested, whatever it is. And so they end up with the default investment option. And the default for most 401k plans is a target date fund based on your birthday, and that's a safety mechanism for the plan sponsor, right? It's for the company.
Yeah.
The company's saying, well, I don't want to leave you in cash because then you could accuse me of not doing anything. So I'll put you in this thing that's linked to your birthday because it's broadly accepted that that's kind of aligned.
Sure.
Okay? But it's not terribly precise, and there's no education behind it. And what happens is you approach that date if the date was actually not related to your real retirement.
Yeah.
So you can be de-linked from reality real quickly in that situation.
I think the other big one is annuities, right? Like
Oh,
we can't trash on them completely because there can be a time and a place, but
Yeah,
I mean,
there's a use case, but they're
for
so
the most
expensive a lot of
part,
the time.
that's where one of the things I think Dave Ramsey gets right. Because he hates them. He
gets a lot of this right.
Yeah, I mean, he
I
hates them, and here's the reality. I mean, we've looked at a lot of them in our office, right? From
Yeah.
stuff that people had accumulated before maybe they even met us, right? And
Yep.
you look at it and you're like, oh, well, that $100,000 you put in is up maybe 10 grand over the last 7 years. Congratulations. Like, it's done virtually nothing, and it probably could have doubled in that amount of time.
You
so
know,
it's like a $90,000 loss.
I've
It's
never
like,
thought
nice.
about it this way before, and I'm going to take a risk of saying this out loud in real time here. It seems to me like a lot of the time annuities get sold on investment principles instead of tactics. I'll explain, right? Principles don't change. I've used this example before. It's a little gruesome, but it hits home, right? War. The principles of war are unchanged, right? Conquer and win, right? It's going to be, loss of life, and it's going to be pretty gruesome, and you're going to take the territory, right? That's the idea, is that wars are generally over territory and philosophies, and but what's changed a ton in war? Tactics, right? We don't use swords anymore and chariots, bows and arrow. No, we're using drones and satellites and all kinds of craziness.
Right.
So the principles are unchanged, but the tactics are radically different. The problem with a lot of insurance products is, because of the way tax law works, largely you're setting something up for kind of a lifetime commitment, but the tactics keep evolving in the marketplace. Right? I've been doing this 25 years, and I can't tell you how many times tax law has changed, how many iterations and evolutions have occurred in the marketplace itself and the way business occurs. It's really very different than when I first started. The principles are not. The
Right.
principles of investments are really similar, but the tactics are very, very different today than they were back then. I mean, we talked about the decimalization of the market. Today you have fractional stock trading,
Right.
right? Fractional stock trading, that didn't exist 10 years ago hardly.
Yeah.
Right, so this is all really new stuff in the marketplace. You buy an annuity, you're setting really something up that is often, like, you can't get back out of it. You're making a permanent tax commitment, for the most part, if you're in non-qualified money when you do it. And
How
if you
many-
don't know what that means, see me after class.
I mean, how many of the times have you seen someone buy an annuity and it's been out of fear?
oh yeah,
you know
it's
what I mean?
always
Like,
pass
why
that
do-
risk to somebody else.
Yeah, I mean, I think that's probably 80% of the reason why people buy annuities. They're just like, I can't take the fluctuations. I
Well,
can't.
how many times have we seen people miss opportunity out of fear too? Well, I won't buy the S&P 500. I'm going to buy a CD.
Basically, every time someone buys the annuity.
Yeah, annuities are a lot like CDs, and they're usually sold as, hey, well, why don't you try to get market-like returns, but with this safety mechanism over here. But then when you look underneath it, it's like, well, yeah, but the safety mechanism costs this much for the insurance premiums. It comes out of your returns, and your returns end up looking a lot like the CDs.
We don't even have enough time on the show today to get into all the hidden fees that can be inside of an annuity that
We
just
don't.
scalp your returns.
Yeah, mortality and expense, the various riders that are in there, whether or not the fees are being applied to the contract value versus the guaranteed value, and oftentimes there's a big gap between the two.
Did
There's
you
just a
mention
lot
the
of
rider
things.
fees and all the other things?
Yeah, I mean,
it's just bleh. Okay, so we talked about that vomit topic. So
Tell me how you really feel, Matt.
bleh. That's how I really feel.
Okay.
Okay, so what about some of the other ones in here? What are some of the other missteps? How about I don't know, unnecessary taxes? That could be one, right?
Yeah.
Like you just sell something early, or you don't time the sale of something right, and then you end up with maybe like a short-term capital gain instead of a long-term
Yeah,
capital
that's
gain.
a toughie. Don't own it for 360 days and throw in the towel at the end, right?
Right, yeah, like you could have waited 5 more days and then saved 20% on taxes, but you didn't know what you didn't know,
Yeah.
so you shot yourself in the foot. Now, hobble your way to the hospital.
Right.
But in the financial world, a lot of the times there is no hospital. It's just like, deal with your wound. You
Yep.
can't undo what you just did.
So this is kind of the cost of advice issue, right? I think one of the challenges that we have in the investment landscape is complexity. Okay, there's a lot of moving parts. It's really interesting to me that you have to be such an expert to understand Social Security, and yet we give it to everybody, and expect everybody to be an expert in it for what? The one time that they're going to actually apply?
Right.
And this is really, there's a lot of moving parts to this. And on the one hand, you could say, well, I'm going to give them the application and I'm going to take the number that they tell me. But there's mistakes that happen. Things go wrong, and you also have discretion over when you apply. It's there's a range of times and how to optimize it and so forth. And it's really kind of tough that we ask people to be an expert in something that's hard to be an expert in. And that's just one piece of the puzzle. Then we look at all the layers in taxes, right? And then
Yeah.
what we just saw new changes to tax law right now. Did we roll out a new class somewhere where all of the American public can go and take a class and understand these taxes?
Yeah, they're
not.
No.
Right? Everybody's on their own to figure this out. Right?
why-
And so
yeah.
that part to me is that complexity thing is kind of the penalty. It leads to fear and it leads to questionable decisions. Right? That it's not the cost of the investment that usually nips the investor. Vanguard would have you believe that if you could have gotten the S&P 500 fund, or you could have got this other actively managed fund, and look, one of them is 100 basis points more, you're doomed, right? If you don't get the cheaper fund, look at how much it cost you. And in pure math terms, over a lifetime, they're actually telling the truth, right?
Yep.
If you have the same performance of two investments, the one with lower fees makes you more money over time. What they fail to report on is the amount of human decisions that can affect the outcome, and oftentimes that price is a distraction from making the good decisions.
Correct.
Right? And there are lots of studies. Vanguard actually did one of these studies. Morningstar had one. I think in 2023, Morningstar said average investor in a 401k paid 0.47% in fees per year. Several of the fees are more than that. But when you look at the Vanguard study before that, so you're thinking, great, look at how much we're paying. Vanguard did a study, or Dalbar did a study. I remember Dalbar did a study in the late 90s. And they said that most investors lose as much as like 3% of annualized return because of unforced errors, bad decisions, and market timing.
I remember that,
Right?
actually.
They
yeah.
just get emotional and make bad decisions. Right? In this case, you're actually better off if you forget. Like, I forgot to deal with it, and I rode through it, and at the end, I came out okay.
Right.
That oftentimes ends up like the accidental, so like negligence may be a better strategy if you pick a decent fund. But you don't want to say that too many times, right?
Right.
You're telling me to not pay attention? No, I'm not. I'm not telling you that. But I'm telling you, paying no attention might be better than looking at it so much that you freak out every time it moves and you sell every time it drops.
Right.
Right? That could really burn you. So anyway, there are some other costs here. I'm looking at this clock though. We got to grab our last break.
Are we there yet?
We are totally there. So we got like 9 minutes left in the show. We're going to grab a break. When we come back, we're going to try to, just help you sort out advisor or not, robo-advisor. What should I be paying for or not paying for? We're going to try to unpack that. Stick around. I'm Dave Littlejohn.
And Matt Dixon.
Yeah, True Wealth. On News Radio 93.9 FM and 1240 KQEN. Okay. Now we're down to two people?
Two investors.
Two viewers? Keep calm.
Three. We're at three.
You, Jan, and maybe Kevin.
Maybe.
We've had 11 though. 11 views total.
It peaked.
Something.
But it probably never got higher than 6 at once.
Nope.
Yep. I'm not convinced that watching the show is terribly interesting. I mean, I don't know that watching this is interesting, but if we give you like the nuggets out of the show later,
Yep.
that's probably interesting.
Yeah. I agree.
They can hear your voice,
Yeah.
You're the voice off camera.
Yep.
Matt disappeared. He's not on
I will
camera.
live forever.
Everyone's going to never know what you look like.
I made an appearance last video.
You did?
Oh, yeah.
I think so.
Maybe.
Maybe it was the video before. No, yeah, it was when Madison was here.
It's good for me to remember just how high these cameras actually are right now. I think as long as they're about here, they're probably okay. I'm looking at that field of view, and yeah.
It would look better if they were lower, for sure. But
They could
we
be.
can't with the tripods because it grabs the computer screens.
Well, maybe we come in some other afternoon
Fix it.
and just build this thing.
Yeah.
Or instead of putting all the effort into that, we could just wait until.
Could do that too.
Seems like nominal effort to me.
Guys like building things out of PVC pipe.
Yes.
Okay.
Yeah.
You do that. Yeah, on the pen.
I'm a fan of building the thing. Yeah. So we really only have to fill 6.5 minutes, Matt.
We got
I
it.
could pretty much just turn this show over to you now. That'll be good.
I think
It's
just
so funny watching you, David.
Why?
Because sometimes when you're talking, your brain is going way faster than your mouth can, and so you kind of just jumble words together, like you can't get it out fast enough.
That's funny.
Okay. All right, gang, welcome back to the True Wealth Radio Show, where we are...
David's buzzing.
Yes. I ran out of time to say all the things.
That's right.
So they're teasing me about, sometimes right now, your brain's going faster than your lips. And I'm like, maybe it is. So,
Perfect.
see,
Cut that.
you're welcome.
You can use that as a short for YouTube right there.
Okay, Matt.
I'm here.
In the final... Thank you. In the final segment here,
Present.
as we are trying to kind of help our listeners, I want to, let's distill this down. Here's the question that I'm going to try to ask you.
Yep.
When is it a good time for somebody to really look at do-it-yourself investing? And at what point do you think it becomes something where it may be worth getting help?
You know, honestly, if a person does go grab a decent index and they're young and they're just in an accumulation phase where it's like, well, I don't have any money, or I've got $1,000 or whatever, and I plan to throw $50 a month into the market, maybe a low-cost mutual fund or something can play a role in that situation for you, right? Because it's like, well, you're going to dollar cost average your way in over a long period of time, and that might just work out fine for you, right? So, because that person probably doesn't need a lot of planning, right? They don't need a will or a trust, or they're just not at that point in their life where they're crossing that bridge yet. Not that it means that they won't get there, but if things are really basic or really simple, or you know what you want, maybe you're an expert in the market and you can do it yourself. That's okay too, right? The way I look at it is like this. If you said, Matt, here's all the tools. I want you to tear that engine apart and rebuild it. I bet you that with enough time, I could probably tear it all apart and put it back together.
I think you could. I've seen you in action.
But I'm going to tell you this. It probably wouldn't run real good when I put it back together. Like something would go wrong, right? Like a gasket would not get sealed correctly. There would be things that went off. And it might run for a little bit, but I'd probably end up breaking it. Or it just would take so much time that it would have been cheaper for me to take it to a mechanic and have them rebuild it, right? Like if it takes me 2 years and it takes the other guy 2 weeks, I'm way better off and I'm way financially ahead to just have someone else do it. And I feel like that's kind of the world that we're in. Like, what do you have time for? There's a lot of people that are smart enough to do this stuff.
Oh, yeah, I don't think we're smarter than our clients.
We just spend all day, every day doing it.
Yeah, we're specialized. We have all the tools for it. It's what we do.
Yeah.
It's kind of like this, right? Do you want to have a garden or a grocery store?
Sure.
Right? I'm grateful to farmers, not because I couldn't learn how to farm, but because they're doing it for me so I can do other things.
Well, and to be honest, your yard isn't big enough for the beef that you need, the pork that you need, the chickens, the eggs, and all the...
Well, again, tools, including the space, right? It all makes sense. And so we sort of divide up the labor and do different parts of it, right? And you outsource parts of your life, and that's normal.
Yeah.
And so we just don't necessarily think about it that way because we're so used to it that we're sort of, numb to that issue. Right?
Exactly.
But I like your answer, right? When somebody's just getting started and you're in the accumulation phase, there's not a whole lot of planning other than I plan to go to start building something, so I have something to plan with. Okay? So getting started oftentimes is more about just start.
Yeah.
You don't need to pay somebody a bunch of money or anything else. I do think that it is okay if you want to just have a conversation with a financial planner and say, hey, can you just get me set off in the right direction and send me on my way? Yeah, that may be great. Okay, but you maybe don't need to have them sort of on call, right? You don't need to be on retainer with an advisor at that point, or you don't need to be outsourcing this, right? At some point, I talk about really busy people. I have a service that handles the yard for me. I don't mow my own lawn.
You know how?
Yeah, I do. I love the fact that somebody else does this for me because I needed to go do other things in my life, and so it was worth it for me to trade my time that way. And at some point, it gets worth it to have a financial professional for most people,
right?
Because the moving parts and the complexity and whatnot are just not something that they want to take their bandwidth and give up in order to do that. If you love investing and you want to be a trade trader or something like that, that's a different animal.
Right.
But most people don't. And so, I think that's the threshold. In the accumulation phase in particular, I think when you get close to retirement and distribution and so forth, for a lot of folks, having a professional is probably worth it.
Yeah, but like when you start getting into the more complex things where you got to know like when should I take Social Security?
Yeah.
Or like how I've got $3 million and the state of Oregon's going to tax me on everything over $1 million. What do I do? Like,
Yeah.
start bringing in people that know the system well enough to say, avoid this error because that's a $100,000 mistake.
Exactly. There is a point at which having good, sound professional advice very well may make you a lot more than you ever spend on it. And I
Right.
think in most cases, good advice, that's the case, right? You end up money ahead even though you're paying somebody because they're supposed to know things that you don't know. Mm-hmm. And then they're supposed to help you execute on those things, get them done, right? So that's really the point.
And it's a weird one because AI might be smart, but it doesn't know the questions to ask you. Like you can
Not so far, yeah.
right? Like you can go put something into AI and it'll give you maybe a great response. But a lot of people don't even know what to put into the equation or into the system. And so that's why you hire someone, right? Because they know the questions to ask.
Yeah.
AI doesn't necessarily know those questions
And
yet.
AI, it can still hallucinate and get certain parts of it wrong. There's a lot of elements at play here that we just, tread
Well,
carefully with. It's
yeah.
a useful tool, but it doesn't even know the questions that it should ask
what I'm
sometimes. It
saying,
doesn't
yeah.
have the intuition like, oh, you meant to ask this.
Right.
And that's the issue, is that it just doesn't, it's not at the point of discernment yet. I think it's going to keep getting better, and so, we'll see, but that day is not now. So
Yeah.
we'll watch it with interest. Look, Matt, as we get to the end here, we got final seconds, music's playing. How do they reach us if they need help?
Yeah, why don't you give us a call or shoot us a text at 541-375-0898 or email us at info@littlejohnfs.com.
All right, well, that's it for now. We got to run. Until next time, I'm Dave Littlejohn.
And Matt Dixon.
You've been listening to True Wealth on News Radio 1240 AM and 93.9 FM and, all the call sign stuff. We'll catch you next time.
That last segment was so good.
Okay. Well, we're going to turn the cameras off now because that's what we do at the end of the show. Like and subscribe and all the normal stuff. Until next time. See ya.
Princess way. I love it.